Hi, I'm Mike Gassewitz, CEO of IAIC, and welcome to another episode of In Focus. Today, we're going to talk about an investment review and outlook at the end of the second quarter of this calendar year. And joining me today is Joel Baker, our Chief Investment Officer. Welcome, Joel.
Thank you, Mike.
So if we look back on the second quarter and even look forward, looking back, kind of a mixed bag, as per usual, I guess is typically the case. You look at things like, are we going to have a recession? Are we not? What does that mean? Or what's, from an inflationary perspective, what are we seeing? The trends on that front and interest rates, what the various central banks are doing in terms of trying to beat inflation or beat it back down. And then basically how the markets react. On top of that, we have the war in Ukraine continuing to drag on, as well as some of the economic data coming out of China. So all these things, I was going to ask the question, what keeps you up at night? And well, that's kind of a stupid question. So instead of asking that, why don't we kind of step through this? And let's start with what probably matters the most from an investment perspective is earnings. What are we seeing from an earnings perspective?
Yes, thanks, Mike. Yeah, you've basically hit all of the items that keep us up at night. That's a good way to say it. It's a lot of moving parts to say that, and a lot of changing narratives from what I'd say a big picture perspective or a macro perspective for sure. So yeah, we'll talk about some of those today. So yeah, great segue. So far, this quarter, we're about say 20% in as far as the S&P 500. I'll sort of use that data. It's easily accessible, but we're about 20% in of companies reporting. And so far, Mike, it's really all over the map. Generally speaking, they're expecting earnings to be down about 6%. And again, that's across the entire spectrum. They're expecting revenues or sales to be basically flat or down, call it 0.5%. But so far, the companies are beating that. So that's good news. They're beating consensus estimates. Again, it's kind of a mixed bag, to use that phrase. Within the subsectors, some are winning, some are losing, and some are just meeting consensus. So it is a little bit of a mixed bag in that regard, but they are beating for the most part so far. So far, so good in terms of that. The trending is down, no doubt about it. So we are sort of trending down if we sort of compared, say, the last 3 to 4 quarters. But generally speaking, we're meeting consensus.
Okay, that's good. Somewhat good to hear. And then how have the markets reacted to either the result and or foreshadowing the results?
Yeah, that's a good one for sure. So a lot of talking points with clients, and to be honest, the S&P 500, maybe we'll just focus on that one because everyone seems to watch that more so than Canada, and it's a little bit misleading, Mike. And really, what I mean by that is the S&P has come back strong so far in 2023. So looking at it from a year-to-date perspective, it's probably one of the strongest rallies on record. It really is that simple. If you go back and look at the data over the S&P 500 going back long times, it ranks in probably the top 10 snapping back, or the rallying back, to use that phrase. However, it's a little bit misleading. And what I mean by that, Mike, is if you sort of look at the performance, it's really on the back of a handful of companies. And to be exact, it's 7. So 7 companies have really carried the strength of the S&P 500 to these record levels as far as a rebound. And if you sort of drill down, this is the kind of stuff that we love as PMs, but when you sort of drill down and look at it, there's only about 23 names that have beat the averages of the performance of the S&P 500 broader returns. So if you include those 7 names, total perspective, only 23 are beating the market.
Right.
That's probably one of the ugliest stats over the last, say, 25 years. So it's really misleading as far as the headlines. But having said that, it's a case where we look at it as, is it really fundamentally driven market, or is it money going back into a rebound?
Right.
So you hit a good one right on the head there. Is it a recession coming or not? The market seems to be not even digesting that sort of data. The labor market's strong, and that's all that matters. So we're driving forward. So that's really the feeling out there. So it's a little bit misleading, but definitely in the right direction as far as returns.
So you mentioned the recession word, and lots of, again, anybody following the various trade papers and pundits and the like, lots of mixed messages in terms of, are we going to have a recession or are we not? It's interesting. I was just reading an article where the term transitory or transitional inflation was coming back, that people are kind of thinking, you know what, this could have been maybe just transitory inflation. So why don't we first talk from an inflation perspective. What are we seeing from a general perspective?
Yeah, that's a great one. So again, I go back to use that phrase mixed bag. It really depends, Mike, on what statistic you look at. So I think you're right. Generally speaking, the central banks increasing interest rates have started to slow some parts of the economy down, no doubt about it. So we all sort of read about mortgages and housing and things like that. However, other areas such as food. So to go out and buy groceries, people will argue that inflation is still here. So we're starting to see that. We sort of see some up in terms of wage inflation. So again, there's the other side of the argument. So generally speaking, it's going down and the central bankers' strategies are working. But to your point, I don't think inflation is behind us. So we're going to see pockets of pieces of inflation still going up. So again, that's part of the fight of the central bankers and how do they combat that or counter that? So keep going with your thought though. You're spot on. There seems to be mixed messages out there as far as a recession. And again, this is probably the same as when we spoke last. The indicators are starting to smell like a recession's coming. Right. So as investors, I think you have to be prudent and sort of budgets, to some degree a recession is coming. Maybe it's a mild one, but the indicators are pointing to a recession coming, probably starting a year from now, just generally speaking. The market doesn't seem like that, but the indicators are indicating that. So that's where it's a little bit of that mixed bag or that mixed emotion as far as the economic pulse, if you will.
And one of those indicators is, what we call the yield curve, and it's inverted. Correct. Maybe just talk a bit about that.
Yeah, an inverted yield curve. And really put simply, what that's referring to is shorter term yields are paying more than longer term yields, which is completely backwards to what we usually think. So why that's important is the inverted yield curve has a very strong probability of predicting recessions. And to kind of go a little bit deeper into that, usually it sort of beats a recession by about a year. And so the fact that we're inverted now indicates that maybe a recession is coming, say, a year from now.
Right.
But drilling down further into that, it's sort of some of that economic data that we love as PMs again. The general consensus or the general forecast is that it's going to be inverted longer now than what we thought. So now they're pushing it out to the inversion even into 2025, which is kind of staggering. So that's kind of what we're seeing in terms of bond land.
Okay. So again, to your point, a lot of mixed messages.
Correct.
So speaking of the yield curve, Joel, let's talk about interest rates. People surprised when we saw in Q2 and even now we saw the Fed just this week raise rates in the U.S. and obviously last quarter, Bank of Canada as well. Thoughts on that front?
Yeah, that's a great one too, Mike. So yeah, we're watching that closely as PMs, as you can imagine. So yeah, the so-called consensus forecasts are that the Federal Reserve would increase 2 more times before the end of the year. Now of those 2 raises, one of which happened yesterday. So you're spot on there. But interestingly enough, forecasts for next year have interest rates coming down rather quickly. So it's almost like it's a little bit of a roller coaster. So they're going up for the rest of 2023 and then coming down sharply in 2024. In Canada, the so-called projections are 1 more increase for the rest of the year. And then no one seems to be taking an estimate for next year. So the camp is out, if you will, in terms of what Canada is going to look like in 2024. Now, the reality of that is, and again, we sort of talked about this last time we chatted, was all eyes are on the Fed. So I think everyone will be watching the Federal Reserve and what they do as far as their interest rate projections before they counter into Canada and even Europe for that matter.
So Joel, with all this information, all the observations, what does this mean? What do you do with this?
Yeah, great question, Mike. So yeah, a lot of client conversations about this. So really with all these moving parts and, we use that phrase mixed bag of economic data here, what does all that mean? So a few things that jump out as sort of going forward items in the portfolio is one, we continue to like bonds with yields being where they are. We can be patient in that part of the portfolio and let the stock market do what the stock market does. So it's almost like that price of safety is very reasonable today compared to what it was, say, a couple of years ago. So we like bonds. The second thing is specifically to the bonds, we're keeping our strategy exactly the same. And what I mean by that, Mike, is we're keeping to good quality corporate bonds and we're maintaining a short ladder. So if we can earn, say, 5.5% in a good investment grade, sort of blue chip kind of name, I don't see much wrong with that. So again, we're utilizing that in the portfolios. But on the equity side, we have to sort of stick handle through all of this noise, if you will. So again, we're playing more defense than offense. So nothing's really different there. We're going to see some volatility here as all of these economic things shake out and pricing models get factored in. So we're staying diversified. We're playing that defense. Like I said before, I think you have to sort of be prudent in expecting some sort of a recession coming down the pipe here. And we hope it's a very mild one, but it just seems like one is coming. So we want to sail the ship in that regard. So all of these names that are going to be there through thick and thin should a recession occur. I guess that's the simple way to say it. And lastly, we just want to stay focused on the long-term strategy. So again, we talk about quality names in the portfolio. Nothing changes there. We want to be properly diversified as these little ups and downs happens within our sectors. We continue to rebalance back to our target rates. That's important in terms of turbulent markets like this, and just focusing on fundamentals. So we want to sift through the noise and stick to companies that are supported by good earnings and good revenues and are supported that way in the market. So
excellent. Joel, thanks for this.
You're welcome. Anytime.
Good to know that you and the team are on top of this. And it's always good for our clients and ourselves to understand what do we do with this? And then how does that mesh in with our whole quality approach or QSEC approach to investing? So again, thanks for this. Folks, as always, if you have any questions, reach out to your accounting firm advisor, or feel free to, again, reach out to your IAIC portfolio manager. And as always, don't hesitate to reach out to myself. Take care.